Hey everyone, it's Richard. You're watching The Plain Bagel. The topic of war is something that's sadly become increasingly prevalent and almost normalized in the current news cycle. In addition to the ongoing wars in Ukraine and Gaza and heightened concerns around Taiwan and China, we recently saw Israel just this past week enter into another direct conflict after assassinating key military personnel and nuclear scientists in Iran, and the two countries exchanging blows thereafter. But as horrendous as the costs of war are and the general concept of war is, there's long been a view in the finance community, contrary to the wise words of Edwin Starr, that war is actually good for something, with that something being money, or more broadly speaking, business. But there long been this view that as countries pursue warfare, they can create jobs, lead to further innovations, and actually generate further economic output, which would seem quite confounding and cynical that something so horrific could actually be good for a country's economy. But is that really the case? Well, with us seeing a lot of posts circulate about how warfare will ultimately impact the markets and the economy, I figured it was something worth getting to the bottom of. And today we'll cover some research spanning hundreds of conflicts over the past 2 centuries to try and figure out how war actually impacts the economy and different investment groups. And to be clear, this is not to belittle or distract from the real tragedy of war that we're currently experiencing. In the grand scheme of things, the performance of businesses during these conflicts very low on the list of priorities when compared to the horrific realities of warfare. That being said, I think it's worth clearing the air about the relationship between the economy and warfare, given that there clearly will be a connection between the two, especially since, as we'll explore, it's not as straightforward as you might otherwise expect, one way or the other. So let's start at the high level. How does war actually impact a country's economic output as measured by gross domestic product? Well, as you can imagine, there are plenty of studies that have tried to explore the connection between these two variables, how economic activity of the countries involved is ultimately impacted by their engagement in different wars. And some have indeed found a positive impact to GDP when a country has entered into a conflict, with the key reason being cited in many of these papers being the higher government spending. During wars, governments enlist more soldiers and often increase military spending on things like weapons manufacturing and equipment. And this spending itself can be an economic stimulant, with it leading to more job creation, even boosting productivity at times as some capital assets see higher utilization. And according to the Cato Institute, people being pulled from family formation and other non-market activities into wartime production. With one report by the European Bank for Reconstruction and Development even suggesting that at times, total factor productivity can actually end up higher than would otherwise be the case due to innovations made during a war, with countries, quote, learning by necessity. A key example of this being how research for the atom bomb eventually led to the development of nuclear power. All of which seemingly supports the idea that while devastating, war can in fact boost economic activity, something we have actually seen firsthand in the United States, which saw its GDP grow 72% from 1940 to 1945 during the Second World War. So you can see where some of the arguments that war is actually good for the economy end up coming from. However, a lot of the more positive research on the impacts of war have typically focused on the United States, which is a bit of an outlier nation, given that while the country has experienced attacks like Pearl Harbor and 9/11, a major war really hasn't been fought on US soil since 1865, the end of the Civil War. And as one of the most developed economies with the strongest military in the world, economically, it's managed to handle past conflicts quite well. But when you look empirically at the history of warfare, at least over the past 2 centuries, it's pretty clear that that's not exactly the norm. And it's really not difficult to find examples of wars crippling the economies of countries involved. Ukraine, for example, is estimated to have seen its economy contract by roughly 1/3 in the first year of Russia's invasion, has seen unemployment skyrocket with roughly 1/5 of its population entering into poverty, and has quickly become one of the most food insecure countries in the world, despite being one of the world's biggest exporters of crops prior to the war. And as you may have gathered from these 2 examples, one of the distinguishing factors here is where the war ends up primarily being fought. In fact, one study by the European Bank for Reconstruction and Development, which utilized the Correlates of War database, took a look at over 700 wars from 1816 to 2014 and found that countries who fought wars on their own territory saw an average decline in their gross domestic product per capita of 9 percentage points relative to their pre-war levels, with the median decline sitting at 3%. And if you graph the cumulative change in GDP per capita, while you do see a wide distribution and a number of positive instances, you can see clearly that the outcome tends to be negative. Now, while some of these drops may not sound all that severe at face value, with the average decline in GDP per capita relative to comparator countries that are not experiencing war sitting at 7% by the end of the conflict, keep in mind that the decline in US GDP during the 2008 financial crisis from peak to trough was 4.3%. And the correlates of war dataset being used here is a fairly broad one. That includes all scales of war, with the minimum criterion simply being 1,000 battle deaths over a 12-month period. In the 20 most severe contractions, or roughly 3% of the sample, GDP per capita declined between 40 and 70%, showing just how drastic the impact can be. So while there might be an economic boost for countries that are somewhat removed from where the fighting is taking place, for countries fighting on their own territory, you can see that the impact is typically quite negative. And there are some pretty visible reasons as for why that's the case. For one, there's the impact on the labor force, not just because of the loss of life or the flight of refugees from a war zone, but also because wars tend to lead to declining birth rates among those still in the country, with population growth typically dropping by 1.5 percentage points relative to comparator economies and remaining 0.5 percentage points lower 5 years after the end of the war, showing the clear impact war can have on family formation. You also, of course, see lasting damage to a country's capital stock when war takes place on their own territory. Factories, agricultural farmland, and equipment can either be abandoned, damaged, or destroyed during conflict, which can severely impact a country's ability to carry out economic activity, all of which tends to lead to an upfront drop in total factor productivity, which, yes, can rebound higher and, due to learning by necessity, can even surpass previous levels in a select few cases. As highlighted by the report, large institutional improvements are the exception, not the rule, with the focus on military spending more often crowding out other investments and even private consumption, thereby slowing long-term growth rates, with government spending as a percentage of GDP reaching over 40% at its peak in the Second World War. Thirdly, you tend to see a decline in a country's external trade activity, with both imports and exports declining and a country's external deficit widening by an average 5 percentage points of GDP relative to pre-war levels. And finally, with war increasing the risk of investing within a given country, nations often also see capital flight, with both domestic and foreign direct investment typically declining due to the heightened uncertainty, something that makes rebuilding the lost capital stock all the more difficult. So yes, while governments may increase their role in a country's economy and that can apply upward pressure to economic activity, these other factors often outweigh any benefit that might provide. In fact, half of the wars analyzed in the European Bank for Reconstruction and Development report saw lessened economic output even 25 years after the conflict, with only 29% of cases seeing GDP per capita return to levels seen by comparator countries without war within 5 years of the conflict. And even in cases where the heightened government spending does lead to a boost to GDP per capita, it does come with its own downsides. For one, to finance this extra spending, the government typically takes on more debt or increases taxation, with the Institute for Economics and Peace finding that in the US, levels of taxation and debt increased during World War II and most major conflicts thereafter. A relationship you see pretty clearly when you graph the country's debt as a percentage of GDP relative to these geopolitical conflicts, with in fact the highest level of debt to GDP achieved by the US being during the Second World War. And over the past 2 centuries of conflict, debt has historically peaked by an average of 47 percentage points of GDP versus its pre-war level, with, as you'd expect, the risk of default increasing during this period. And the second impact, as you might expect, is inflation. Not only is heightened government spending generally inflationary in nature, but for countries fighting on their own territory, the destruction of capital and impact on the labor force can lead to the cost of production to increase, with countries seeing a median 8 percentage point increase in inflation when compared to pre-war trends when fighting on their own territory, with, in extreme cases, countries even experiencing hyperinflation in instances where governments end up printing money to try and cover their expenses, with Weimar Germany after the First World War being a commonly referenced example of a country that saw its currency completely collapse in value after the war. So when you expand the lens beyond just GDP per capita, even in instances where that might be positive, there are other factors worth noting here that can have pretty clear negative impacts on a country's economy. And unfortunately, while we've so far just looked at the countries directly involved in these conflicts, there can be some spillover effects for other countries as well. With one study by the Center for Economic Policy Research, which had a smaller sample size than the EBRD report, focusing strictly on larger conflicts, finding that countries closest to a conflict see an average 10% decrease in GDP growth and a 5% increase in their inflation rate after 5 years of the conflict, with even distant countries seeing their inflation rate rise an average of 2 percentage points after 5 years. And depending how integrated a given country is in the global economy, the international impact can be quite pronounced. There's actually a tool called the Price of War Calculator developed by Kiel Institute that helps illustrate how much wars in various countries would cost the global economy based on when and where it occurs. And you can see that even for Iran, a fairly heavily sanctioned country, a war could end up cumulatively costing other countries more than double what it would cost Iran itself over a 5-year period. The big factor there being the impact war can have on the production and transportation of certain key commodities, namely in this case, oil. So yes, there are instances where GDP per capita might increase for a country that's involved in a war, even if it's on their own territory. But outside the fact that this is just one potentially even biased and limited figure for assessing the health of a country's economy, most wars actually result in a decline of GDP per capita, an increase in sovereign debt loads, and global inflation rates, especially in cases where key commodities end up being affected, which hopefully goes to show that there's not a tremendous amount of evidence that war is in fact good for business, unless again, you are perfectly isolated from its costs. But what about stocks? Again, very low on the list of important things during wartime, but as we've highlighted on this channel, the economy and the stock market do technically measure different things. And if US stocks, which represent a good chunk of the global market, are so insulated from war, how have they performed during past conflicts? Well, a lot of research has shown that upfront, stocks do tend to have a negative initial reaction to the onset of a geopolitical crisis. However, they have proven quite tenacious over time, with LPL Financial finding that the S&P 500 has taken a maximum of 307 days and an average of just 41 days to recover all its lost ground from geopolitical shocks ever since Pearl Harbor. But in terms of whether there's a direct correlation between stocks and war activity, the impact there gets a bit complicated. While there is some research to suggest that defensive stocks do in fact see a benefit from the onset of a geopolitical conflict, given that they're the companies to directly benefit from higher government spending, one CFA Enterprise and Investor article found that the performance of the US stock market during major past wars has varied quite a bit from one conflict to the other, with stocks falling during the First World War, but actually experiencing positive returns during the Second World War and even the American Civil War, with an analysis by the Institute for Economics and Peace highlighting that there did not appear to be a direct relationship between average stock market valuations and America's post-World War I conflicts. Even the sectors that performed well during these past conflicts might surprise you, with the CFA article also finding that some of the strongest sectors during the Second World War had very little to do with war efforts and seem to go against conventional wisdom. Now, it's not to say that stocks are magically immune from the impacts of war. If a country sees its economy devastated, that's going to devastate investors in that economy. And we've seen historical examples of investors being effectively wiped out, such as in China in the 1940s when the government expropriated investor assets, and countries like Japan and Germany, which both saw a near total wipeout of their equity markets following their defeat in the Second World War. But given America's security, the country has fared fairly well historically. So interpreting the impact of war on different markets is a lot more convoluted than you might initially expect. Even gold, for example, which has historically been treated as a safe haven during wartime, seeing its price appreciate, often only sees this boost last temporarily, with the price often normalizing downwards after the initial spike, which goes to show just how complex the web of variables that will impact the ultimate economic and market outcome with a war really is. With LPL chief equity strategist Jeff Bookbinder highlighting this week that even past sell-offs around major geopolitical developments such as 9/11 or the Gulf War occurred at the same time as other major economic headwinds, stating that other economic variables often drive US stock performance over geopolitical conflicts. So much like many other videos on this channel, the answer to the question of how wars affect a country's economy and its stock market is it depends on a number of different variables: who the country is allied with, the equipment they have, the scale and intensity of the war, how long it lasts, where it's taking place, and throw in that the very nature of war is changing over time, and analyzing the impact of war gets very convoluted very quickly. Nonetheless, hopefully this video helped to bring some nuance to the discussion to highlight that, well, yes, you can see a boost strictly in, say, GDP per capita or even around defense stocks and the like. There are many other negative and severe implications that would generally disprove the sentiment that war is good for business. And hopefully, for reasons well outside of that, we start hearing less and less about it. Thanks for watching. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the topic in the comments down below. Thanks again for joining. And as always, be safe out there.